Hey everybody, welcome back. Well, we have a lot to go over, so we're going to jump right into it. Now, we can all see the neckline right here, and it's my favorite time of the year because we get monthly charts. Now, people would say, well, why do you even need monthly charts? Because you can't day trade off of them. You want to know where you are at all times. And there's a couple patterns here that are repeating themselves in all the indexes, so we must pay attention. And again, you have a 12, a 22, and a 55. This is on a monthly, and this is what I use. You should use what you're comfortable with. But we can see the bone of contention right up here where we had an issue on the S&P. And we're going to stay with the S&P, but we're going to look at all of them. I got a lot of great comments about the heat map. I'm going to show you a couple different ways that you can use the heat map again that are telling you a lot. There's a specific pattern I'm seeing over and over again, so we're going to address that pattern and how you can take advantage of it. What we're seeing right here is just straight pullback from this date. And everyone would say, thank you, Captain Obvious. But I think that what you have to understand is what this pattern is. So to start with, we know that we have a macro event here, we know we have a fundamental event, and we know that we have a technical event here, which leads us right back to the stool, which we constantly talk about. But what else are we learning from this? Well, this bar completely encapsulated that bar. So you have a bearish engulfing and straight down at the top of a chart. It really doesn't get any clearer of what could mark a top technically. You come straight across. This bar encompasses those three bars. It is very clear that this becomes, as we refer to it, what? A control bar. So what we would do with all control bars is we just want to mark them, right? Anything that's going to encompass a large swath and change the entire trajectory of the market becomes a control bar. So we have the top up here, we have the control bar, and this is why I love monthly charts, because sometimes when you look at things from 34,000 feet, they start to look a little differently. So if this is the control bar, you can see that we're settled right in that control bar. Now, what's important about this is up. 1, 2, 3 down, up. And this is one of the most highest probability candlestick patterns that just exist, period. If you're in the community, you're already well aware of it. We document them as much as we see them. But you're up, and then you have the complete encapsulation of the move down, and then it explodes within 1 month, challenging what? The control bar. So this now becomes major support, higher high, takes it out, and we push. Why is all this important? Because this pattern triggered, and this is the result of that pattern. What we're seeing now is follow through. Now, when we look at this monthly chart, no one's going to go out there and say, oh, we're having a really bad time of things. Things are not going great, right? You would look at this chart and go, the market looks great. It's when we start doing this with the weeklies that the devil's in the details. You start seeing the down, the inside, the dragonfly pattern or hammer that's right here. Got a bunch of hammers on Friday, which we'll be going over. And then we can start seeing the moves, and we can start seeing the nonsense that's going on here. If you take it from there, and you drill it into a daily, it's Armageddon if you ask certain people, right? The end of the world. So why is this important? It's important because you have to understand that those monthly charts are made up of 30 data points right in here, roughly 20 data points actually to make up a month, right? And then you have the weeklies, which are made up of what? 5, sometimes 4 bars. So it's important to understand that these weeklies are created by these dailies, and these monthlies are then created by what? The weeklies, right? You can also just break it down that each one of these is roughly 20 daily days. So it's always very helpful to understand how these bars are created and then go from there. For example, you know that 6.5 hours of trading makes up a daily bar, but then when you equate that out to how many of those in a monthly, you start going, oh, that's why you would still want to look at monthlies even when you trade. That's why we're doing this, and it's extremely helpful. Now, if we just look at the simplest of indicators, and just by looking over its moving averages, there's very little that we should be concerning ourselves with here on a monthly basis. So when we're pursuing this stuff today, getting that view from 34,000 feet, looking at the Dow, it's probably not the worst idea in the world. And what it does, it allows reflection. If you could all do me a favor today, if you hear anything different, not only in the voice, but in what you're seeing on the screen, let me know, because I switched systems over. So I'm curious if you note any difference. I did some tests. I haven't noted any. Here's the diamonds, and then we can see up, down, 1, 2, 3, right around the same period of time. In July, August, September, October, November. We all know what happened in November. We said we're not going to raise rates anymore. And quite frankly, with the data coming out, I'm going to jump ahead a little bit here. Spoiler alert, they're not raising rates. And quite the opposite. I think we have issues. And we're going to address those. But if you're looking right here, you can see, and you would then know that this is major support. Whether you test it, don't test it, we don't know. We also know the following. This is a control bar. Why do we know that? We were unable to close above it. We also know that this bar has encapsulated 2 previous months, and then we've been unable to go higher. So this is a control bar on the diamonds, and that's why it's important for us to reflect on these and take a look. If we are to go out there and look at the Qs now, you're going to get a very different picture. Now that picture would then give you the control bar from obviously up here, and then of course it gives you the same control bar that you had earlier with the S&P. And when you look at that and how we responded, up, down, 1, 2, 3, up. This bar encapsulates everything. That becomes the new control bar. Control bars are very important to me, and I don't think a lot of people spend time talking about them. But you can even drill into a control bar on a minute chart. I'm going to show you this and how to identify them later in the day. And it's a very simple technique to note them. It's not very complicated at all. But if you're going to take a look at how things are playing out right here, you're wedged in, you can't get over, bonk, hits, bonk, bonk, and then you flip, and then you go. Understand this concept, because when you're looking at these charts, people would say, wow, the diamonds really, we saw a lot of action in the diamonds on Friday, which we did, but we know better, because now we're going to go into the weekly and then go, well, does that look great? Well, I mean, it looks better than being kicked in the shins, but it's not overly exciting, is it, right? Control bar tries to get through on the weekly, boom, kind of this wonky hammer. Look at the daily, and you're giddy, you know, as a schoolgirl. So, like, I look at it and go, okay, well, what does this mean to us? And how do we, you know, what do we do with it? We just understand where we are in the pecking order. So yes, if we're going to trade this, maybe we trade it. Maybe we start looking at some of these names. But we must understand that what we're having in here is we're having some issues. Okay. The point being, before we start all high-fiving the bros and start saying, oh, we're going to start getting into industrials, I think what we have to do is just realize that maybe that's not the case. Maybe what we need to do is just take a step back and look at what's playing out. Now, there's no easier way to do this than to start looking at monthly charts and realizing that anyone that has been getting out of the Dow for the past decade has been making a huge mistake. But there are times when it does make sense to get in the Dow and out of the Dow. And I'm not sure about which one we're in right now. What I will say is this: if we take a look at the IWM and we just do, again, all I want to do is just look at the simplest of things. Here's your control bar right up here. Now watch this. Since this control bar has been set, you haven't had an issue, right? You've tested this level over and over again. You're finally flipping it. And are you starting to see a change? And this is why I love monthly charts. If we take a look here, I could argue that, yeah, you are seeing a monthly change. So out of this control bar, we try to flip, rejection. Remember, wicks are price rejection, complete Matumbo, rejection. We get a little further, up, 1, 2, 3 down, up. Well, that's kind of not overly exciting, right? Like, that's not the best thing in the world, but what did you do here? You kind of marked a bottom, didn't you, in November? That bottom stayed there with the IWM, and I think that's important for us to get. So, okay, so we have a bottom in the IWM, we flipped, we've retested. This is what's important about what's happened here on the monthly and why I love monthlies. You have retested here. Tries to lift, can't lift, this bar is still in control, but all of a sudden, this is becoming support for the first time. And we're not getting back down to that level, if you'll notice. You're getting tighter and tighter in here. And this is a really important distinction. Now, one of the key things that I got asked a lot about was the heat map and how to refer to the heat map. So we're going to take a look at this, and I want to show people how to use this effectively. So I have this set at all US companies. Now, the first thing about a heat map is this. You can change anything you want on the heat map. You can go through any of them. This is on TradingView. It doesn't really matter who you use. But if you want to do the S&P, you can. If you want to do all US companies, you can. I think you're better off starting with all US companies and then drilling into it. And then you can kind of go from there. For our purposes, for this, if we just went through and said, okay, well, here's the S&P, you're going to get a different outlook, right? So let's start with all US companies. And then from there, we can go through it. And now you're looking at everything that the universe has to offer. And what I would do is, we talked about how you would click off of these and then just look at what was the worst or what was the best. And I think that's the best way to use a heat map. I don't really see the value except for the pretty pictures and just looking at all this. Like, and just going, ooh, like I don't know what that does for me, right? So every time we use a tool, what we want to do is find out the best utilization of that tool. So I'll say that again. Every time you're using a tool, you want the best utilization of that tool. If you're an electrician, you're not going to use a drywall knife, right? There are tools that you use for jobs. So for me, it's the extremes. So what were you dumping on Friday? Like, what did you have to get out of? And it was AVGO. It was Dell, which was the dumpster fire of all conference calls. And that's from somebody that's still long the stock. Marble. And so you're going, okay, well, tech was a dumpster fire. Out of all US companies, it was tech. And it's very clear that it was tech, and we can see that in here. So that's something we'd have to look at. Spot, DDOG, TME, and we just go through the list. MDB, again, dumpster fire. They rank these by market cap. And then, of course, what you could do here is change by number of employees, dividend yield, PE, volume. So like, let's say you want to do this and go, yes, I'm interested, but you're blowing these up on market cap. So AVGO's move is not what I need. So let's look at volume on the day and then click at volume on the day. Well, that is a completely different picture, isn't it? So all of a sudden, that move that you saw in AVGO that is taking up the entire map, that has your eyes focused, right, on AVGO, and AVGO must be the bad guy. I'm not saying it's not, it doesn't have issues, but if you go, well, where was the most volume of the day? And then you're going, oh, well, I don't know what that name is. I don't know that name. And then all of a sudden it changes your entire picture. Now, these could be names that make absolutely no sense for us to look at, or they could be something that we want to utilize. For example, if we take a look here, this would be the one that had the most volume. Now, do I really care about this? Not particularly. Right? This is not something that I would ever play with. It just looks like an absolute disaster. So then what you're doing is you're looking at the names that you might recognize and seeing if there's value in that. And then you'd go up here and go, okay, well, maybe Mara. Well, that's really interesting. Mara in technology service had some of the highest volume that it's ever had. And that's outside and compared to Riot. So I've had more. Please watch what I'm doing here. See how Mara is bigger? That is based upon the volume. The volume was bigger there on Mara than it was on Riot. S had bigger volume than Riot. So what you're doing is you're comparing not the move, you're comparing the volume of the move. And this is a really distinct, really distinct thing where you're looking going, oh, okay, so you're telling me Snow had more dumping and more volume than MDB. So then you start going through these moves, and what you can do is identify the next opportunity. So in other words, looking at Snow, well, that's just an outright dumpster fire, right? And now you're looking at this breaking down a key level, which it is breaking down a key level. And then you compare that to something like an MDB. Now, what's fascinating to me about MDB, and this is from somebody that was short it, made a little money and got out of the way, that didn't fall apart. That really didn't fall apart. Matter of fact, you have a doji down here. Dojis are what? Signs of uncertainty. So now you would look at this and go, okay, well, which one of these would you want to be short? And then you can kind of take a look back and go, well, what did CRM do after it fell apart? Well, everybody and their sister had to get in the next day because they're like, well, it was bad, but it wasn't that bad. And then you go, well, what did Workday do? Okay, and then you're like, well, Workday continued to fall apart and then caught a bid. Does Snow look like it's catching a bid? Okay, so what you're doing, and I'm going to walk you through it again so that you can do this for yourself. It's important for me that people get these concepts. If you can't figure out why I do these videos, I get asked that a lot. It's because the information and education that's out there, 90% of it is god-awful. And I've been trading 25 years, and I'm trying to educate people on what it takes to truly be successful doing it. There's nothing more Machiavellian than that, guys. People in the community at this point know that. But if you take a look at this, it would also tell you, well, geez, I want to short one of these, dumpster fire Bitcoin names. And then you go, okay, well, how about Mara? Because that has the most volume. And then you look at the chart and go, well, I held right in here, or did I? And then I broke. And then you might overlay the simplest of indicators and go, well, there's the 55 and I bounced. So if I crack here, great. If I don't crack here, then I want to pay attention to it. We just created a trade of interest, and we did it off the heat map, right? And we did it by looking at all US companies that are out there. And people would say, well, I just want the S&P 500. Well, go for it, right? That's on you. And you could do the same thing. But where I'm going with it is, do I really care about the market cap? Or do I want to know why the heck HPE sold down 4.7%? Or why in the world they're dumping these utility names, right? Like they're going out of style, which they are. So this tells you where the volume is, so that when you go back and look at this and go, I'm looking for shorts or I want to get in, you could go through this and go, well, for whatever reason, VST is the one they want out of the most. So if I was looking for a short position, and I'm not saying that I am, but if I was, and I am always looking for a short position, I may look at that and go, oh, okay, I don't need to be in a hurry to buy VST right now because now I have a new control bar. See how it's all connected? And then you'd say, well, how do you know that's a control bar? And he'd say, well, this is one long, nasty red bar that encompasses several days of movement. Therefore, this bar is now in control. And then you would just kind of go, oh, okay, see how this did it? Control bar. That one bar encompassed several days of move. What bar is in control? That bar is. And then you can actually look at them and go, well, what does that tell you? Does that mean it's the end of the move? No, but it means that, you don't have to be in a hurry. Maybe go get a cup of coffee, wait a week or two. And then, okay, tries to rally, doji, boom, breaks out, and then it goes, right? Okay. This is all connected from the control bars to how you use the heat maps. everything. But once you understand what something is, then you can figure out how to use it to the best of your advantage. If I wanted to buy a bank right now, which were on fire the other day, which bank would you look at? Well, you might want to find out what's going on at Bank America and why they're getting the majority of the volume. You might want to go and take a look and say, well, Exxon's Exxon, sure. But we could always do a relative comparison of these two names, but we know why MRO is moving already, so we're not going to bore ourselves with that. And then we look at the communication names and we see what's going on in AT&T. You might drill into the other names and see what's going on there. These are all the ways that you can use the heat map to your advantage. And these are only some of them. But if I wanted to go out there and say, what name in tech do I need to be looking at right now? I probably would be better off going with the names out there that have the majority of the volume right now and trying to understand not only why, but how I'm going to get involved with them. So for example, if I went out here and said, I want to buy a bank, well, which bank would you buy right now? Maybe buy the one with the most volume. Maybe buy the one that everybody's trying to pile in. Because if you compare by volume and you're not comparing by market cap, you're going to look at USB and you're going to go, oh, I'm just going to buy JP Morgan. Right? And there's nothing wrong with buying JP Morgan. Nothing. There's nothing wrong with that trade. But is that the same thing, or do I have a control bar? See, hopefully you're getting how this is all connected, right? And again, it's really important for you to get these concepts. So please drop the comment below if you're getting it. But this is really important to me to see it, because now I can see that they are buying finance, all right? They are buying some of the utilities, but they're not buying the utilities that we were buying, that everybody had to be in. And it can also help you identify moves. For example, you now know that Icon was moving here because of Caesars, right? He got involved in Caesars, that's why it's moving. But it also would tell you like, hey, if I wanted to buy tech on this dip, I wonder what name was up the most with the most amount of volume. And then you at the dinner party would go, well, I'm glad you asked because it's CRM. And then you could high five all your bros and then try and get in the trade. Now we need to focus on. Now, some things are getting better. Some things are worse. And I'm going to explain what I mean by this because you're going to say, well, what's getting better? So one of the things that happened on Thursday, if you were in the pre-market live, was this number right in here and that 1.7 and how disastrous. So whenever I see something that's like that out of whack, meaning we're expecting 3.9 and we come in at 1.7, whenever I see something that is that off, I investigate it. And I want to walk you through how I do that. And then you have 1.3 versus 3.4. And we're going to talk about that dumpster fire in a minute because this is a recessionary number. Anything under 1.5 growth is just recessionary. If you backed in 2% inflation, you can do the math and figure out why it would be recessionary. And that's at 2% inflation. So just consider that. So, and then again, you have the housing sales, home sales, which nobody is talking about this number, but we're going to talk about it. So there's some data that comes out, and then what we do is we interpret that data, right? That's what we do as investors. Now, one of the things that I noticed for me, and I was kind of shocked by this, was that number. Like this is my forecast right here, and then this is my action. So I went and got all the release dates and I went back 10 years. Now, to not bore you to tears, I'm not going to go through all 10 years, but I did notice something. And when I analyzed the data, May, for whatever reason, May is always a dumpster fire. And I'm not sure why it is, but if we go to 2023, here's negative 6.8 versus negative 0.9. And no matter when I went through it, it was always negative. And I just thought that that was worth pointing out. Like, obviously this is going to be bad because it is the, it is what it is. I mean, it was just the pandemic. It was bad. But then you go out a little further and then you see it where it's not the same way, right? So you go out to May again, and here you are supposed to come in at 2, and you come in at negative 3. And then you come in at 6, and this was like this was like the best one ever, right? And you still missed, but it was the closest that you had out there. You're supposed to come in at plus 2.3, and you come in at negative 2.5. So I'm not sure why May is always off, but it must be something with the calculation. And it's always important when you're doing analysis to go back and see, is your thesis correct? My thesis of that being such a poor number was not accurate. So I want to point that out before even going further. So when I'm thinking corporate profits are that off, well, for whatever reason, based upon how they calculate it, May is always a dumpster fire. So if we know that, then we can move forward, right? Because you always want to look objectively at what's happening, not find the thing that fits your narrative. There's no money in that. There's no money in finding things that fit your narrative. All right, so then we have housing sales. Well, if I was looking for a dumpster fire, I found it because here you are, and this is the single lowest level going back to 2020. And if you go back even further, it's actually worse. We're not going to go back further, but I just want to point this out. people are not, they're not buying homes. So the idea that everyone's out there and they're buying homes, it's just not true. If we look at GDP, this is, again, a dumpster fire. You have these quarters that were bad because you cut and everybody was in panic mode. But look at what's going on here. 4.9, 3.4, 1.3. This is what you want. 2, 3, and then, oh, it gets a little hot, comes back down to 3, 2, 3. That's where you want to be. Now, nothing ever was where we want it to be, so we have to play the hand that we're dealt. But to go from 3.4 to 1.3, I don't need to find a lot of other things that should scare people besides the fact that you're watching our drop and it's that significant and it's that fast. Now, on Friday, we had PCE that came out, and PCE is really important. As a matter of fact, I mean, we all saw the PCE and how it did, right? We all saw this right in here. Bear with me, it's a new drawing tool. I'm trying to get used to it. And again, if you notice things that are different about today's video, I appreciate if you say something about it because it's obviously, it's obviously new to me as well, working off this new system. But if we just take a look, like right in here, this PCE, it's definitely something that I wanted to pay attention to. And I think everybody paid attention to it on that day, right? So for us, what does this really mean? It means that are prices coming down? And if they're not coming down, then that's a problem. But here, you came in at the actual 0.2. Okay, and then we put 0.3, and consensus was what? 0.3, and here was your forecast. Now, why is this important? It's important because it tells us that besides food and energy, prices are coming down. The problem with this is we kind of need food and energy. So the idea that we even created something that doesn't include it, it just always seems silly to me. But if we just look at everything, it came down where it was supposed to. It came down where it was supposed to, again, year over year. The big shock to the market, to me, where the big shock to the market came was 945. And this is something that we're seeing more and more of. And it became a concern, especially when we went through this other data the day before. And we're going to get to that. And you have to look at smart money, dumb money, because what's going on there is just, someone used to say absolutely glaring, but tries not to say it anymore. But here you are, consensus 41. Just so we're clear, anything under 45 is a de facto like rate cut. Like it just means not only are you in contraction, because anything under 50 is contraction, right? So you have that demarcation line that we talked about, right? But anything under 50 is retraction. Anything under 45 is like de facto, we're probably getting rate cuts. And so if we look at the consensus of 41 and the previous of 39 and coming in at 35, that means it's contracting even harder. Now, people could argue, well, Chicago is not the same because people moved, this or that, blah, blah. You're splitting hairs. The number is the number, and it's just the way the number is calculated. It doesn't matter. What you have to do is you have to focus on the number and then see what transpired due to the number. Okay? Of course, a Fed speaker, why not? Once we understand that all that matters is the number, and let's focus on it, and then let's tear the number apart and see what it actually means, right? That's what's important about this. So for our purposes, this is not something that I put together, but something that somebody else put together. And I believe that I should always give credit when someone puts something together. This is by these guys, Veta Advisor Perspectives. I don't know who they are. No idea. I saw this graph. The graph highlighted it perfectly what I want to show you. So I want to just get it out there. Now, the shaded areas that you're going to see in here are going to be what? They're going to be recession, because you have to have a recession if you have this. Let's just go on the premise and say yes. Now, why am I giving you the like the milquetoast kind of answer? Because statistically speaking, anyone that studies statistics knows you need 30 data points for any kind of level of statistical significance. We don't have 30 data points. This is what we have. So we have to play the hand that we're dealt, not the hand that we want, right? So we go here and you go 35.4. Okay, well, back here in 01, when we hit that was a recession. All right, and then you hit this in 09. And that was a dumpster fire. And of course, when you shut down the world, you're probably not going to produce anything. So, okay, so we're getting some movements here. And then you look here and you go like, oh, 82, 83. And, that was an area and that's a recession. So you have 82, 83. And then you have right around 01, okay? 01 is really where this came out, not 02, it was 01. End of 01, I believe. And then you have the tail end of this, which is really around the end of 09. So they're going to be really important data points for you to remember. Now, I like referring to books and giving people information. So there's a book that I would suggest that you take a look at called The Hedge Fund Edge. And it's going to tell you something that I'm about to show you. It's written by Boucher, and sickly brilliant guy, traded for a living, wrote a book, lived on an island. But go look it up, The Hedge Fund Edge. If I have time, I'll actually clip it and show you the book. But there's certain books that resonated with me, and this one definitely did, and would explain what I'm about to show you. So here we are. We go to Chicago Business Barometer, ISM Manufacturing, PMI, ISM. Why is this important? Well, this is going to be important because we have data coming out on Monday. And that data is going to be the ISM manufacturing, and it's going to be looked at really closely. And what we're going to notice is that 47.4 up here, 35.4 here, and we can note that how this moves. Now, ISM manufacturing takes into a point more than just Chicago, okay? But it's pretty darn close. And what you're seeing with Chicago is it's really wild, but it's not that wild. Eventually, this catches up. And what they're showing you here, and I think they're doing an exemplary job of showing this, and it's why I wanted to use this, is if you take a look at the Chicago, right, up here, oops, I don't know how we did that. Oh, there we go. Oh, there we go again. All right, we're gonna have to leave that in. But as this goes, maybe if I just click on this button, that might be easier for me to do. Let me see something. There we go. Who's got it? Great. But as you can see, these peaks and the discrepancy, 35.4, 47.4, you get it. And you have the volatility of it, and you want to watch that. So this is going to be really important for us to watch. Now, I'm going to show you my belief on what's important about this data and what's really not important about this data. And the easiest way to do this is just to mark off exactly where this happened. Now, if we always look at a chart, the chart is the chart, right? And the charts don't lie. But if you take a look here, this is 01. Now, why is 01 important? 01's important, 09's important, 2020, and when this happened again, the Chicago PMI is important. And now we've just had it happen again. So this is important. And what we're just going to note real quickly is that in 01, when this happened, which was actually right around here, was actually the state right there. So that's when that happened. Now you rolled and you took out the low. All right, there was a lot of other extenuating circumstances when this happened. We still took out the low. So we have to call it what it is. We can't say, well, this time it's different. No, this time we took out the low. This time when that Chicago PMI hit, we did not take out the low. It became the low. This time when that number hit, it became the low. This is when the number hit. Now, again, I'm not going to say it is what it is and that we're going into a recession and therefore the market's going down. See, from our perspective, when we're doing these videos, what do we really care about, right? All we really care about is just how does this affect trading? That's what all these videos are predicated upon. How's this going to affect our trading? And if we're looking at these areas and going, well, that's definitely something here that I need to pay attention to, or that's something here I'm going to have to get way better with this drawing tool, way better, because this is exhausting. But what we want to do is we want to focus on these dates and then just say, okay, is this of significance to us? And the answer is yeah, it's definitely of significance. Does it mean that the market's going to fall off a cliff? No, because really, like if you looked right in here, and let's get rid of this. If you looked right in here, to me, no, it definitely doesn't show that. It would show the exact opposite, quite frankly. And I think that that's an important distinction for us to pay attention to. Don't always look at this data and just assume that, oh, it's definitely going to be bad because of this. Because I don't view that as a bad spot to enter. People would say that's a bad spot to enter. I don't view that as a bad spot to enter. Does that mean that that's what we're going to get here? Not necessarily. And it certainly doesn't mean that it's not going to get worse before it gets better. And that's another thing that we need to focus on. Now, some things are getting better. Some things are worse. And I'm going to explain what I mean by this because you're going to say, well, what's getting better? So one of the things that happened on Thursday, if you were in the pre-market live, was this number right in here and that 1.7 and how disastrous. So whenever I see something that's like that out of whack, meaning we're expecting 3.9 and we come in at 1.7, whenever I see something that is that off, I investigate it. And I want to walk you through how I do that. And then you have 1.3 versus 3.4. And we're going to talk about that dumpster fire in a minute because this is a recessionary number. Anything under 1.5 growth is just recessionary. If you backed in 2% inflation, you can do the math and figure out why it would be recessionary. And that's at 2% inflation. So just consider that. So, and then again, you have the housing sales, home sales, which nobody is talking about this number, but we're going to talk about it. So there's some data that comes out, and then what we do is we interpret that data, right? That's what we do as investors. Now, one of the things that I noticed for me, and I was kind of shocked by this, was that number. Look, like this is my forecast right here, and then this is my actual. So I went and got all the release dates and I went back 10 years. Now, to not bore you to tears, I'm not going to go through all 10 years, but I did notice something. And when I analyzed the data, May, for whatever reason, May is always a dumpster fire. And I'm not sure why it is, but if we go to 2023, here's negative 6.8 versus negative 0.9. And no matter when I went through it, it was always negative. And I just thought that that was worth pointing out. Like, obviously this is going to be bad because it is the, it is what it is. I mean, it was just the pandemic. It was bad. But then you go out a little further and then you see it where it's not the same way, right? So you go out to May again, and here you are supposed to come in at 2, and you come in at negative 3. And then you come in at 6, and this was like, this was like the best one ever. right? And you still missed, but it was the closest that you had out there. You're supposed to come in at plus 2.3 and you come in at negative 2.5. So I'm not sure why May is always off, but it must be something with the calculation. And it's always important when you're doing analysis to go back and see, is your thesis correct? My thesis of that being such a poor number was not accurate. So I want to point that out before even going further. So when I'm thinking corporate profits are that off, well, for whatever reason, based upon how they calculate it, May is always a dumpster fire. So if we know that, then we can move forward, right? Because you always want to look objectively at what's happening, not find the thing that fits your narrative. There's no money in that. There's no money in finding things that fit your narrative. All right, so then we have housing sales. Well, if I was looking for a dumpster fire, I found it, because here you are, and this is the single lowest level going back to 2020. And if you go back even further, it's actually worse. We're not going to go back further, but I just want to point this out. People they're not buying homes. So the idea that everyone's out there and they're buying homes, it's just not true. If we look at GDP, this is, again, a dumpster fire. You have these quarters that were bad because you cut and everybody was in panic mode. But look at what's going on here. 4.9, 3.4, 1.3. This is what you want. 2, 3, and then, it gets a little hot, comes back down to 3, 2, 3. That's where you want to be. Now, nothing ever was where we want it to be, so we have to play the hand that we're dealt. But to go from 3.4 to 1.3, I don't need to find a lot of other things that should scare people besides the fact that you're watching our drop and it's that significant and it's that fast. Now, in front of us is the trading journal that is linked to the account or that I use in the account for the Alpha Chasers community. It is extremely aggressive the way that this account is run. And I want to get that out there before we go there. So it is basically day trading, running and gunning ideas. This is one account. This is not how I trade everything. So please understand that when we start to look at this. Now, also bear with me as I get everything that I want set up here. But the important thing about it is the trade expectancy, the profit factor, the win rate. And what I see a lot of people doing is they're always talking about their win rate, 70%, 80%, 90%. It's just not accurate. And you don't need it to be accurate. What you need is a process. So what you're always trying to do is work on your trade process and your management process. I went over this in another video. I want to cover one specific trade here and show you how everything that we just went over, how we actually use this to trade. And what you're always focused on is your win-loss. You always want 2 to 1. Profit factor is a little higher right now because of the volatility. The profit factor is higher this month because of the skew and the change in the skew. And it's really important to get. But if we look at this account and we went to the beginning of the year, and then we just went to, probably just used the 31st, right? And okay, so now you're up 593 or close to 6. I think we started with 168 or 170 for those that ask. And you have your ups and downs. But the important thing to take from it are a couple things. Your win rate's 54%. Your profit factor is 188 and you're at 159 over here, right? Your win-loss. I try to get this as close to 2 to 1. You want this as close to 2 to 1 as possible. But man plans, God laughs. So, and then your trade expectancy. And what you're always trying to do is just get an equity curve that just goes up. Now, your equity curve should be going up, but you got to realize that when you're starting, you're going to have dips. And even, you can see me in here that, I had dips even here. Okay. So, and I've been doing this 25 years and I've been trained to do this by people that really knew what they were doing. I was very fortunate in the way I learned. The important thing about it is just understand that you're going to have dips and you're going to have spots where it's just not going to work. And then you're going to have home runs and you're going to have singles. The important thing is to get the process down. You don't need to be hitting 90%, 80%. The people that are getting you to do that are trying to just create dopamine, where they're trying to get you to just, oh yeah, we're always winning, always winning. You're not always winning. It's exhausting. It just doesn't work that way. And anyone that's in the community can tell you that. Anyone that's been trading for any period of time can tell you that. This is the month. And some months are going to have a better win rate than other months. And you understand that. Like if you look at your win rate here and your trade expectancy, this volatility is triggered. And the reason that we're doing better now is because the volatility, right? I'm getting the volatility. You look at April, you're right around the same, but your trade expectancy was much lower. Your profit factor was 136. Your win rate was 104. April was, was just ground and pound game, where May, it's on like Donkey Kong. You have the same win rate, but the moves are greater. This is because the skew changed. So hopefully you see how this is all connected. Now, in front of us are NVIDIA puts that we bought in the community. I'm going to walk you through the timestamps and I will show them. And if of interest, I can show the live trade, but I'll do it in another video because of time's sake. We have a bunch to go through here still. And what I want to do is just, this is where we entered. And it was a very simple entry, but we knew that NVIDIA was in trouble. And I walked through earlier how we knew NVIDIA was in trouble. And we all know the Dell news. So you already knew that you were in an issue. But what we're watching is we're always watching the highs of the first bar, right? You're always watching the highs of the first bar and you want to see how that goes. Now people will say, well, that's not your first bar. Okay, so what I'm getting at is, and I'm going to walk through it in greater detail, see the movement that you have from here over, right? And you see how this became the battle zone? Let me show you what I mean by this before I throw everybody off. You see where you're at right here, 930? Okay, that's your first bar. See how you reacted into that first bar? And how that first bar created this entire area, this entire what we'll refer to as ecosystem. And it presented an opportunity for us to get in because when you went through, you had the rejection, then you popped over again. Right into that pop is where we put the trade on. And again, these trades that I'm putting on, they're not huge on a percentage basis, right? So when I put these trades on, really they're roughly 1 or 2% of the account. That's all they are. They don't need to be a lot. You just need to know and be going for the right amount of movement, which I don't think a lot of people are with their option trades. I think they're trying to kill it and put huge trades on in the right spot and then pull something out like this. That's not why you should be doing options. You should be doing options to make multiples, not to be pulling out 50%. It's exhausting when I see people doing that. I was a registered option principal for 9 years. I can tell you point blank, you will get torn apart in time. You'll keep hitting wins and losses. You're trying to do risk versus reward that is exemplary or just trade stock. There's no reason to be doing this for 50%. It's silly. So anyway, you can see the movement here. This is where we got in around $3. And then we're just scaling out as it's breaking down. So for me, I'm always using these kinds of areas as demarcation lines. Oh, you're going to break here finally? Great. I'm going to assume that you're going to rip back up after. I'll get out, washed out down here, got out of more. And then by the time it was done, we were able to identify a key area in here where we got out. And then it made this higher high, or it looked like it was going to make a higher high. It actually triggered something else, and I got out of the way. And I'm constantly using demarcation lines. And I'll be really clear about that so that if people are saying, well, how can I do this? Or well, give me something that I can add to my trading style. Add demarcation lines. And you're like, well, what's a demarcation line? Okay, when you break down and you hit a new low, and then you rise, and you come down and you're not making another low before you make another high, that's a demarcation line. Okay? Just like up here, and you're making that high and then you reject that high, that's a demarcation line. And by putting these in, all you're doing is saying, where do I have buyers and sellers? But the important thing about this is all I did was put it on here. And I was very clear that I wanted to leave this on and let it work because of, again, we just went through the skew. But you see where you're at, and all I'm doing is pulling out like 20, 25%, because I'm waiting for the big move. And I know people are like, well, that's the big move. I thought we were going to gap fill on the trade, and I'll walk you through that in a moment. That was my target. I always have targets. Whether or not I get there, I still follow the process. And then this was the higher high where we kicked out the rest. Let's walk through the whole trade, and I'll show you the timestamps. So let's talk about how you can do this trade, whether you're doing it with stock or options. It really doesn't matter. What you're always looking for is you're just looking for an edge. So for me, I always, as I talked about earlier, I'm looking at control bars. And what do we have here that happened on Thursday? This bar completely encompassed these two other bars. Therefore, everybody up here is underwater. And what are they doing? They're hoping and they're praying. And we all know how that goes. So what starts to happen is that I've already identified this as an opportunity, one that I don't want to play with because why? I need to see what's going to happen with Dell's earnings. But it's identified as an opportunity on a daily chart because you've encompassed these two other bars. And there were some other things as well, but we can just put the simplest of indicators in and realize that I'm pretty far off of here. And we have a gap below. So to me, my target area is going to be here. It's going to be that gap right in there, and we'll get to that in a moment. Now, the easiest way to refer to these are retests. And as we saw earlier, what we're doing is we're watching a retest of the open. That's all we're doing. So here's the open. We can watch the retest drop to here, and that we get a test of the previous close, and it doesn't do anything of consequence. It rips right back up. So are we putting the short on into this drop? No, and we're not doing that for a couple reasons. One of the first reasons is we know the tick chart and we know that we're completely out of position. If you don't use the tick chart, I would strongly recommend that you do. You can tell very clearly, do you have the probability of going up or down off the open? It is a great tool to use to tell you whether or not you need to chase or what you need to do. So we let the tick chart sell down and set itself up. We allow everything to normalize a little bit, and then you're starting to see right in here. So all I'm waiting to do is see this, and I'm just looking for some kind of bounce. Any kind of bounce over. Because once we bounce over, I know that that's my stop. So I'm finding a spot of interest, and my spot of interest is that open. It's right here. I don't have volume on this chart. There's no reason. We know we have a ton of volume. I don't have a 9 EMA on this chart. It's pointless. We don't have VWAP because you already know you're above VWAP. So why do I need these tools right now? You don't. When you're making decisions, you want to make them fast. The easiest way to make a fast decision is to have the least amount of variables possible. You looking at things that already you know exist are pointless. So once you get to this level and you flip, all I'm waiting for is a higher high close over that level, and then I would just blow out my puts and reassess. And I never got it. And then it starts to break down. And then as it breaks down, we're just looking for critical levels to make decisions. Now, as you could see right here was a critical level. And once that starts to happen, we start getting out of the trade. But it's important to note when we're doing this, we have a lot of other things going on. So we knew the setup, and we knew this based upon what we talked about with the skew, the economic data. You're connecting all the dots. This is how the macro, the fundamental, and the technicals all link together. So then right here, this is John typing in the room, just so you can see the timestamps, and this is where we put them on. In the community, blah, 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 bought some 1100s, $3. And then these are other trades that we have on at the same exact time. And then you can see that ZS, MDB, Dell, NVIDIA, we're short all of them. We were short everything. And the reason for that was because we knew what was happening. And we knew that the volatility was going to increase during the day, which presented us with what I think was a unique opportunity, because I don't think people expected the follow-through, because I don't think people do enough work. That's my personal opinion. Anyway, some people just don't even know where to look, which is why I do these videos. But if you sit there and you watch this, all we're doing is just waiting for this to drop down. And as it's dropping down, we're getting out of the way. Now I'm going to put in the timestamps here so you can see what happened. And what was kind of crazy about this is actually when we closed the rest of it, you can see what we 10x'd it, and then I only had 25% left, and then I just moved that to a 500% stop. And that was like a 12.20, and then by 1. What was crazy about this trade, and why I love these kinds of markets right now, you're going to get so much volatility, you can actually start taking the other side of the trade. You weren't really able to do that much of this year, where you can go long and short in the same day and kill it. This is presenting opportunity. I do want to point something out, because I stated this earlier. When you're at this part in the trade, you don't need like a VWAP. You just don't, right? But as the trade develops, it does help you to have that in. And I want to clarify that. Off the entry, I don't really need it. But once it develops, you do want to see that you are rejecting that VWAP and the trade is going the way that you want it to. Now, for me, my target was here, which was the gap fill, right? I always want a target. Doesn't mean I'm going to trade it, but I was off by about $3, $4. It just never got there. It is what it is. And then we just start to see a development. And then that development's right here. It's actually kind of funny, but we actually bought the 1100 calls, and we actually did well with them. We made a couple bucks on them, and then they actually went in the money, which was crazy. So we had a shot there, and we were up so much it made sense to do it. But we also had a day trade there we pulled like $8, $9 out of. But anyway, I can do it in another video. But you should be able to see in here one of the demarcation lines. So one of the questions I get a lot is, how do you know your trade's busted? Well, you hit a low, you get a wick at the end of the low. I can overlay RSI with this as well. And RSI gave you a clear indication. We can do that in a second. But you see when you start hitting these levels, you're pulling back and you're not making a lower low and you're getting tighter. It means you're getting rid of supply. Here's a demarcation line. Once you flip the demarcation line, I'm like, that's it, that's enough, right? Because maybe I'm not going to get that test again. But clearly here at that point, it's like, okay, that's enough. Let's just pop this in real quick so you can see exactly what I'm talking about. But hopefully you get how you should be looking to enter these. For me, when I start seeing stuff like this, and people will say, well, I don't use RSI. That's on you. You don't have to use anything that you don't want to. But when I have like a washout near a key level, if I'm not looking at RSI, I feel like I'm doing myself a disservice, because and what I'm looking for is I'm really looking for divergences, right? So if I'm here and you start seeing this and you're at the bottom of a chart like that and you're not paying attention to that, I think you're doing yourself a disservice. The same kind of disservice you're doing here if you're long, right? So on the long trade, people will say, well, how do you know like where you're scaling out, or what would bother you about the long trade? This is where we got out of the sum of the long trade. Well, if I'm here and I'm seeing this, right, on the same time, and I'm up here and I'm going, well, we're going here, okay? And you can see these areas right around 122, 127. Let me show you something. When I'm not on the video live trading, I actually am the one that enters like the alerts, and I'm there obviously all day because I trade for a living. But if you look at some of this, right? So these are where we close the puts. All right, this is where we get in the calls, and right, and it's a total spec play. But you can see how quick I am to get out, right? Like I'm like up to trimmed, right? Like I'm not playing games. Calls are up 30. I'm not doing anything, but there's nothing wrong with trimming. Once you understand that you are fighting a trend and your trend changing, your goal is to get out, not in, right? Like you have to realize, like I'm fighting the trend. I'm trying to tell the market it's done going down. Good luck with that. But that's what we're doing here, right? So you have to understand where you're at. So you're pulling out money faster and faster, okay? There's a dynamic that shifts there with that kind of trade versus this kind of trade. But what I start doing, if you look at the timestamps, as you're pulling out, pulling out 5, all right, I'm up. All right, we're pulling out some money on the options. We're up 75%. Pull something out, pay for them a little bit and see if you're going to, hit, if they're really going to hit. And we had such a cushion, it made sense to try after we saw the edge. But then here, NVIDIA day trade, $9 out. Look at the timestamp, okay? So it's really important to get the timestamps on these and when this stuff's starting to happen. Even up here with the 5, if that timestamp was right around 118, look at when we pulled money out of the option, 126, right? So you get when these are out, okay? Now you come here and you take a look at this divergence. When do we start pulling out money? Right as that divergence is developing. When did I get out of the whole trade? 134 right in here. Okay, that's when we got out of the trade. So right here, and there's that divergence. So I understand when people say I don't use RSI. You don't have to. I use RSI, and RSI gives me significant indications on where I need to be in or out. I've been playing with RSI so much, I created my own, I have my own metrics on RSI. Meaning like I've changed the way that they actually use the numbers that they use in here. It is a huge tool that if used correctly, you can benefit from greatly. The money in using RSI is in the divergences, and you can clearly see that here in this chart. It's not so much, oh, I'm overbought, I'm oversold. No, it's really in the divergence move. I hope this was helpful. Please comment. Now, the reason I covered the detail is your comments. It's why I ask you to comment so I know what to focus on. It does everything in how I create the videos, literally everything. And I get asked a lot about smart money, dumb money. I'm going to spend, due to time's sake, I'm going to spend some time on this now. But I get asked a lot about smart money, dumb money, and I always get asked about not only smart money, dumb money, but the trades, and that's why I'm going over those trades in such detail. It's very important to me that you get it and that you share. There's a lot of misinformation out there, and I just want to show people what it truly takes successful to do this. You guys are at a great time to learn. I can't stress it enough. When I started, we didn't have all the education out there, but you have another issue. You have to sort through what works and what doesn't. So I'll leave it at that. Smart money, dumb money. We're going to spend more time on this next week because there's a lot of devil in the details here, but for time's sake, I want you to get this concept going into the week. We don't refer to this as smart money, right? We refer to this as what? Institution. We don't refer to this as dumb money. We refer to this as retail. Why? Because the way that these are calculated, they are calculated in a way that shows institutional calculation and retail calculation. I would argue that in red, dumb money does much better going long, right? Here, and watch what the market does as we're going long. So as we're increasing, because we're retail, we're dumb money, as we're increasing, the market's increasing. Well, that doesn't make us dumb money, and institutions are selling to us. The difference is the mechanism, right? Retail moves like a cat in a hot tin roof, and basically we have institutions that trade like turtles, like they're never in a hurry. Look at how long it takes them to move, right? I mean, you can just say it versus how long it takes us to move. We're like, we're in, right? And then we're like, okay, we're out. We move fast. So understand that. They move slow. But when you start to cross this line right here on smart money, dumb money, and this being dumb money, it tends to mark at least a short term. And that is one of the things that I just want to point out because we crossed the other day. But there's more to it, and we have to go through the spread. For my sake, I think I'm better off pointing out some things that are out there, and your sake, some things that are absolutely glaring, in my opinion. So what I wanted to show is I want to show you some of these earnings that have come out so that you get my concern with the earnings and the GDP. If you take a look at like MDB, this was a dumpster fire of a quarter. This was not a great quarter. And as much as I love the AI plays, and as much as I am long Dell, and I am very grateful that it held here and that I'm still up in the trade, because this, while it was a dumpster fire floating down the river, could have been a lot worse than it was. What's pertinent about this for us is to understand that this, when you look at Dell, was not the greatest quarter, You know, what they're going to do is tell you 127. They're going to point out that it missed. It really didn't miss. It was 126. They standardized because of the whisper number. The whisper number was 132. The estimate at the time was 126, right? They used the estimate and then they flipped to whisper. If you never could figure out why this changed, that's why. So whisper is like, what are they really telling their institutional clients? So you missed the high end, and the call was a dumpster fire. It wasn't great. ANF did exceptional and they had a good quarter, but these are explosive moves that lead to what? Just exhaustion. The same thing that we saw with NVIDIA. If you watch these calls, and again, for those that are new, welcome, but we link all these together. We called this an exhaustive buy the day it happened on Tuesday, and we were long. So understand that, and that could just mean that we're going to go sideways for a while. Costco, great quarter. How'd the stock react? This is where it gets really fascinating because you shook everybody out. But are they marking themselves to market because of the end of the month? We don't know. We look at the Argentina trade, and I'm pulling out very specific trades for a reason. You're going to see it. Look at how the Argentina trade's setting up again, right? So we're seeing that, but where are you seeing the real money being made? Well, you're seeing the real money being made in names like DEC. What we're seeing is this retail movement, and I would not sleep on specialty retail because it's lower beta stuff. Lower beta means they're not going to be as worried. Why would you not be as worried? Because you're not going to buy puts on retail names. You're going to buy puts unless it's ANF, but why are you going to not buy puts? You're not worried. It's not going to drop 1,000 points. They're not going to, it's not trading like that, right? And watch this. When we go through all these at the end of the day, and I sorted by change to save us time, look at Foot Locker and how Foot Locker reacted after yesterday's move in the undercut and the rally. Look at Kohl's and how it reacted after the cut and under rally. Look at Target, which has been on a tear since that quarter. Okay, when you start to see these and you start seeing names like even ELF start to reverse, it is very clear. You're seeing some moves on like AEP, which is in the space of energy. I think the energy space is interesting for sure, but it's retail, and then it's retail, and it's retail that have held before. Also, look where else they're going into. They are also going back into the Lilly trade, the NVO trade. And why are they doing that? Because they don't have the same kind of high beta moves. They're not going to be affected by the skew. They're not going to be affected in the same way that GDP is going to be affecting the high beta tech names. Hopefully you can see how this is all connected. That's it.